You said lots of interesting things, I think, and to me it seems that you European politicians, they should endorse your proposals. I imagine how much easier it is to solve the problems via the banking union rather than going down the road of fiscal union and even a political union. So I'm a bit surprised you mentioned that Angela Merkel and others are a bit reluctant and critical to your proposals, because as a political scientist, at least I see that this is a much more likely track to go rather than the full-scale political and economic union, genuine economic and political union, as they call it these days. Now, lots of more competent people than me are in this room, so please indicate. Any questions? Benzo first, Trane first.
Thank you for a very stimulating talk. I think I understood most of what you what you said. But is it fair if I say that you are mainly dealing with this in this talk as a liquidity problem, liquidity crisis, and that the banking union as a possible shock absorber is, at least that's what I kind of heard. And I was wondering, when you take that perspective, things seem very clear as as your further points follow. But there are a couple of things you don't talk about when you've chosen the angle that you have chosen. And a couple of things that I stopped to think about when I listened to you. I hope there's a question at the. Well, I think the nature of the intervention is a question anyway. One is that liquidity flows have sort of been solved at the moment, the imbalances from north to south, by austerity.
The flow imbalances.
Yeah, that you talked about. Sort of, why aren't they no longer in a current account deficit? Because they are in austerity situation, which means that all kinds of other problems pops up other places, like mass unemployment among youth, negative growth, worsening debt to GDP ratios, and political instability. And so I'd like for you to expand your analysis and say something about the interaction between the solution you're talking about and these problems at that end. And quickly, two other issues I'd like you to comment on. Is one, I was thinking all the time about what about the role of the nature of financial markets in creating this crisis. You didn't say anything about re-regulation of financial markets that I heard. And just one fairly simple technical point. I apologize if I misunderstood the technicalities here. Is that in order to make deposit insurance into a good shock absorber, you would have to restrict some of the financial innovations that created the wholesale market that preceded the 2008 liquidity crisis. Because one of the problems of the 2008 crisis, the way I understand it, is that banks were funding themselves in ways that would not be covered by deposit insurance schemes. So I could picture all kinds of financial innovations that would make deposit insurance less effective as a shock absorber, and also just the size of the financial sector and some of the dynamics of the financial sector that is part of the crisis picture in my view didn't touch upon. And the third issue is that it seems to me that financial crisis is often, when you look through when you shift through the debris, you often find pretty poor governance, political corruption in Spain, Ireland, Iceland, so that there's a link between the creation of a bubble and how well the institutions of that country work. You could probably come back with saying that Nevada hasn't got the worse political governance than but at least in Europe that seems to be the picture. And also I would say it partly holds for the US itself if you look at some of the bigger institutions. Thank you.
Okay, three issues there. First on the banking and then the austerity unemployment situation, and then the re-regulation of financial markets, and then thirdly the governance structure aspect. Can you take all of those three now?
I'll try. Now, on the regulation of banks, or re-regulation, that's necessary, but my assumption is we have booms and busts anyway. We try to avoid them, but even with the best regulation, they will still be there. So that's why I didn't want to emphasize too much that particular aspect. a part of any boom is then malfeasance and some sort of corruption and misbehavior. Because when there's easy money around, it always arises. My view is that is more an accompanying symptom of the boom than its underlying cause, in most cases at least. I mean, Albania in the 1990s was different. Okay, Iceland, we can discuss. You said my view was it was liquidity. Now, we have to be careful. My view was not that it's a question of liquidity. In the acute phase of the crisis, of course, you have a problem of liquidity. But my view was that the banking union provides more than just liquidity. It provides shock absorbing against losses, actual losses which have to be taken. And that's why I made the example of the Baltics, which did not get liquidity from the ECB. But the losses, local losses, were not borne by local banks, but by banks owned by Swedish and other people. So that's where the losses were. So that's what's so important for me, that you can actually have losses there. And by the way, the FDIC is an example of deposit insurance which works pretty well, despite lots of financial market innovation. And actually for Europe, as I said, I would actually like to have some securitization back. If all Spanish and Irish mortgages had been securitized and sold to European investors, then the losses would have been spread all over Europe. And we wouldn't have the localized problem of the banks going bankrupt and the government going close to bankrupt. So I think securitization can be very good. In a boom, when everybody believes this stuff is 100% safe and you have a housing bubble, then securitization can have negative aspects. Doesn't mean it always has it. So for Europe might be good. And then what did I not get?
And then there was one on governance structure.
No, austerity, I think.
Austerity, that's the second.
I think that is unavoidable. When you have a very large current account deficit as a country, and you have what's called a sudden stop to capital inflows, the only way the current account can change quickly is by consuming less and importing less. That you can do quickly. Expanding exports always takes time. There's no way you can accelerate it a little bit, but it takes time. You can reduce your imports by almost 50% in half a year. You cannot double your exports in half a year. And therefore, this is unavoidable. The question is, how quickly does it take place? How flexible are the economies? How quickly do costs go down? That varies from country to country, and that's what structural adjustment is all about. The Baltics were pretty flexible. The Greeks were not at all. But growth in exports is now the one area where demand should increase in the peripheral countries. Government demand goes down, and exports ideally should offset part of that. That's the case in Spain, that's the case in Portugal. And what few people realize, the strange thing about Greece is that exports have further fallen, despite an improvement in competitiveness, despite a big fall in Greek wages. Exports have actually fallen and deteriorated, have added to austerity instead of compensating it. And that's why Greece is in such a bad shape. If Greek exports had done what Spanish exports are doing, for example, then the situation would already be much, much better there. But my view is austerity, unemployment in the short run is no way around. The only question is whether you can redeploy Spanish construction workers somewhere else in 7 years or in 10 years. That's the time frame we're talking about. Less than 7 years, I don't think is.
And that's also related to the governance structure issue then? Oh, yeah. Okay. Then, over here.
Sorry. My name is Sølve Steinhovden, working with the Ministry of Foreign Affairs, partly with these issues, but not so much on the monetary aspects. You said you were discussing how to attain financial stability, and as I conceived it, that was stability or resilience to shocks that somehow would accrue. You didn't necessarily specify how. But at the outset of your intervention, you said that the reason behind it all was the excess saving of the countries in North Europe and the excess deficits of the countries in South. And in my mind, those imbalances are there caused to let's say, too high productivity in the north and too low in the south. I'm not sure if that's right, but in a characterized manner, it could be put like that, maybe, that at least there is an imbalance there. And I don't see really how a solid financial system solves that problem. Maybe you could explain that to me.
Okay.
Thank you. I had expected that question. So actually I had prepared some material. I don't know whether that can be put on.
There's a presentation called Oslo 2. The hidden presentation of the
okay.
expected question section.
Let me start with the one thing. The story about Germany. Germany made major reforms and became more competitive. That is wrong. German productivity has been lower. Productivity has been lower than most other euro area countries. Here's let me just say a brief word about the fiscal consolidation, and I come to that. Okay, that's the crisis pattern which I mentioned. That's the current account. That's okay. The longer term. Let me say where I had this statement. It was not this one here. Let me just. Okay, on the austerity, because it's very important. Here you have the US and the euro area, blue and red. Now, austerity usually means you're cutting deficits. Now, where were deficits cut more quickly? In the US or in Europe? In the US. So in a sense, there's more austerity in the US than in Europe. On average, there has been very little austerity in Europe. People just talk about it endlessly. They always read, yeah, the Spaniards, they have to cut. They started at 9% and now they're down to 7% of deficit. Greece started with 15. You cannot go on with 15, right? So I think there's been lots of exaggeration about the amount of austerity we actually had. And then there's a question, actually, does austerity lead to a reverse impact on the debt-to-GDP ratio? Well, let's just take the published estimates of the debt-to-GDP ratio. It's supposed to decline. It does, actually, very on average. So it's right. But we know that in the first year, the first 1 or 2 years, there will be deterioration. That we know in the short run, but we also know that then in the longer run, when you have a balanced budget, then in the end, the debt-to-GDP ratio will improve. So I think there's a lot of exaggeration on this account. Of course, it's true that you have these current account, which were imbalances, and now it's just one imbalance, which is the German, which basically means that the euro area has to run a current account surplus, like a little Norway. And the only question is whether it's a weak euro and a strong euro area economy, or the other way around. I think that is what is realistically on offer. Now, I think I don't have it here. Yeah, I mean, the way it's achieved in the short run is, of course, a demand compression. I have another slide, which I want to put in there, which I look at productivity. And if you look at productivity, economy-wide productivity, output per man hour, you see that Germany was the worst performer in the euro area, bar one country, which is Italy. And if you look more carefully at the German experience, you will see that actually German manufacturing productivity has increased nicely. Less than in France, but it has increased nicely. Whereas productivity in services has been stagnant. And now I come back to the famous question of reforms. Reforms in Germany were a little bit to the labor market, and the German manufacturing sector was under intense international competition. But there were no reforms in the German services sector. Services are still 70% of GDP. So it's not surprising that productivity growth in Germany has been pretty weak. Where does the current account surplus in Germany come from? 80% because the Germans stopped investing and consuming. Demand compression. Not through a government deficit, a government surplus, but just, and partially also that, but mostly because people stopped consuming. If you take German consumption today and 10 years ago, it's the same. In Greece, it's still 20% higher. In Spain, also still 20% higher. But in Germany, it was really demand compression, which happened from the below, and investment compression. That's why you have a huge German current account surplus, not because Germany has become so competitive. And the problem is, of course, now the Germans should consume more, invest more, but they're not doing it. Because the rest of Europe is also doing the same German game. So that, of course, creates a problem at the euro area level. Everybody is in a recession. But I think if you look back over the last 50 years of international financial crisis, it's always been the same refrain: the Germans should consume more. It has never worked.
Okay, Nils Borten.
Nils Urga, I'm a commentator. I would like to put a political question to you, like the question Mr. Arne Melchior ended with, nearly, which is when you look at this crisis, 5 years, and you look at the probable outcome, you have outlined them for us very well. How would you estimate the impact on the political project which we call EU and Europe?
I would say it will be divisive. Let me come back also to your point about industrial structures. We all know there's a suspicion in economics that when you integrate more, then you have a concentration of economic activity in the core, and the periphery gets deindustrialized. That might very well have happened, but the key question is, if the periphery realizes that and reduces consumption along with lower incomes, there's no problem. My best example is always Bulgaria. Poor, corrupt, peripheral, no industry, but they adjusted consumption to the low income. The government didn't run deficits, and the country is not a financial problem. It's poor, it's corrupt, nothing moves, right? It doesn't improve, but there's a difference between that and basically consuming too much. The Portuguese had zero productivity growth, but they wanted to consume more. So they run current account deficits at 10% of GDP for 10 years. 10 times make 100% of GDP foreign debt now. They have to service that debt. So they have to reduce consumption below the 2000 level just to pay the interest on that debt, because they're overconsumed. And that's the problem. The credit boom allowed them to overconsume for a very long time. Sometimes you had actually GDP going up, measured GDP, because it was all consumption GDP, which was not sustainable. Boom stops, consumption part of GDP is no longer there. You say, big recession. Yeah, but things which were unsustainable just couldn't go on. And the question is now, do these countries accept the new reality? Okay, here I'm going outside my own domain as an economist. My view and my experience is that people resist and complain about changes, especially when the standard of living goes down. Once it stabilizes, they get used to it. Germany was very similar. Lots of problems during the 1990s when it went down in Germany. Then it stabilized. And people saw, oh, it's not so bad. From stagnation, we're getting to plus 0.5% increase. Hurrah! Spanish unemployment rate has stabilized and has gone from, I don't know, 35 to 34. You see? I think that is going to happen. We are not there yet, but this phase will soon start. And then people will, I think all this excitement about this close integration will slowly dissipate. And I would say that at the EU level, things will continue much as before. Because as we discussed, most of the banking union stuff is very technical, and it works below the political radar screen. So you have some people in Frankfurt who look after banks, but you don't read about their newspapers every day, and you don't care so much. You have some resolution mechanism which from time to time might dissolve a bank, but people don't get excited about that. Provided, of course, the economy stabilizes. Okay, there, of course, we have a difference of opinion. Paul Krugman will tell you this will go on and on and on. His view, okay, not mine. My view is it will stabilize because actually the austerity was not that strong, and will stabilize, and over time more people in Spain will be employed in making exports. Hopefully some Germans start a little bit at least to consume, and then over time we can get back to modest growth rate in the south, and in 10 years the pendulum should have swung back. With people not being very happy about the EU, but basically saying, okay, there was a big crisis, but we survived it. And now, after a long period of adjustment, we are back.
Øystein Noreng.
Thank you very much for very interesting presentation. I have a question concerning the external shocks. Europe isn't alone in the world. We have trade partners, competitors, that are pursuing devaluations when it's a situation like in the 30s. Britain is the best example. They try to devalue, they want inflation, they want the standard of living down, they seem to succeed. Well, it's a small economy. The US is partless, and you can see the QE is a way to devalue the dollar. They want the dollar down, want to become more competitive. Japan is the latest addition to this club. How do you see Europe in that context?
Actually, UK is a good example. They have devalued a lot. What has happened to their trade balance? It has deteriorated. What has happened to their growth rate? On average, I think almost worse than the euro area. So I must say, I don't see the big benefits of currency depreciation. And the one thing that the German model tells you is that in the long run, Germany was able to live with a strong exchange rate. Now the key question that we have today is, this was valid at times of generally close to full employment, modest inflation, and the booming world economy, not booming, but growing world economy. Does that apply still today? That's a question that's really very difficult to answer. My reference to the UK example says, here we have an almost nationalist agreement 10 years ago. So I would be skeptical. It might be true that the euro is too strong, but I don't see the big negative impact on the euro area economy.
Could I have one short question towards the end myself? You said, I think very strongly throughout your presentation, you stressed the need for the banking union, and you said at the same time there's no need for a fiscal union and there's no need for a political union either. Could I? And at the same time you said that not all of these elements of the banking union is likely to be realized. So it will be some kind of halfway banking union. What are the main hindrances, as do you see it today, politically, institutionally, and in the market, in preventing the establishment of a banking union? And why isn't it possible to make it as kind of the sufficient banking union that you would advocate?
Well, one element is, of course, the problem of the legacy assets. You have countries where there are large losses, and for the Italians and the Spaniards, the idea is banking union, so we put all these losses in one pot, and the Germans can pay for it. And the Germans, rather say, we are willing to pool risks for the future, but the past you're responsible for yourself. Now, where does the past and the present and the future diverge? What is the value of Spanish assets? Very difficult to decide. And that makes it very difficult to go to a full banking union today. That's one element. There, probably only time can tell what the Spanish mortgages are worth. A more fundamental problem, however, which has emerged both with Greece and with the latest Italian elections, is a fundamental mistrust in the quality of the institutions in different countries. Let's say we send the Troika to Greece, collect your taxes. After 3 years, they still haven't done it. Corruption hasn't changed. I would say I'm not surprised, because you cannot change these things from the outside, but that's something else. But what it becomes apparent is that deeper integration with other countries where you suspect that governance doesn't work, it's very difficult. Especially you have, let's say, the same banking rules, but what if they're systematically disattended or corrupted in one country? And also you have to have a certain political commitment in these countries that actually body politic will stick to it. You sign papers saying, yes, banking union, we give up, we will not meddle with our banking system, the banking institution will be independent, and so on and so forth. And then when you see election results like the one in Italy, you ask yourselves, can one trust these countries for the next 30 years to be responsible partners in an area where we are pooling more risks through the banking union? The more risk you're willing to pool, the more you have to rely on the quality of the others. The nice thing for me about banking union is you don't really have to rely so much on the government institutions, but on the banks themselves. You can actually supervise it by the ECB. So I think this objection is much less strong for a banking union than for a fiscal political union. But instinctively, in the minds of policymakers and the electorate, of course, the two are mixed. And I think this disappointment about these low quality of the institutions in some member countries, which wasn't apparent beforehand, is one of the key reasons why I think a full banking union is present not possible, and why, in general, I think further integration in the EU will become more and more difficult.
Okay, we're running late. Thank you very much, Daniel, for sharing your thoughts and remarks on this. This is not a country that are struggling in the financial crisis or euro crisis, at least not at present, and not at the same level, at least. Although we are very much exposed to it, partly as a huge investor in Europe, and also as an economy that's closely integrated into it. But thank you very much for coming up here. He came from the US this morning, travel up here, and returning tonight to Brussels. So thank you very much.